What happens to the global economy when the world's most powerful central bank abruptly rips up its own playbook? On Wednesday, June 17, 2026, Federal Reserve Chairman Kevin Warsh stepped up to the podium and delivered a shockwave to Wall Street. Instead of the imminent financial relief everyone expected, a 4.2% inflation spike forced his hand. He froze the benchmark rate, stripped away the market's safety net, and quietly set the stage for a massive shift in global liquidity, a phenomenon institutional insiders are already calling the 2026 capital vacuum. Welcome to the new era of American monetary policy. To understand how we arrived here, we have to look back at the chaotic energy shock that gripped the markets earlier this year. Following the outbreak of the Iran conflict in late February, global supply chains braced for impact as oil and natural gas prices violently surged. This geopolitical friction bled directly into the American economy. By May, consumer prices had accelerated at an alarming pace. Mainstream financial media began reporting that annual inflation had unexpectedly jumped to 4.2%, the absolute highest level we have seen since April of 2023. This wasn't driven by everyday retail spending. A staggering 60% of this massive price increase was fueled entirely by the soaring cost of energy. When you track this pressure across the broader economy, the visual data is undeniable. The underlying index tracking all consumer prices has steadily climbed to a reading of 313, illustrating a relentless, accumulated weight pressing down on everyday purchasing power. But this is not just an American problem. When you look at the global landscape, the divergence in purchasing power is staggering. Over in Turkey, the national economy is buckling under a crushing inflation rate of nearly 54%, destroying local wealth. Meanwhile, Argentina is trapped in a historic financial spiral, battling an apocalyptic inflation rate exceeding 133%. Contrast that structural deficit with Japan, where inflation sits at a tightly controlled 3.27%, showcasing an absolute market asymmetry across the map. Back in the United States, the Federal Reserve faced a severe dilemma. How do you measure the true health of the economy when energy markets are in absolute turmoil? This brings us to a highly specific metric used by the central bank. You will often hear financial analysts talk about core PCE inflation. Think of core PCE inflation, like checking the weather without looking at the wind or rain. If you step outside during a hurricane, you feel the storm. But meteorologists sometimes ignore the temporary wind gusts to see the underlying baseline temperature. Core inflation strips out the chaotic, highly volatile prices of food and energy, the things that jump around every day, so the Federal Reserve can see the actual underlying temperature of the economy. And when you strip away that volatility, a different picture emerges. Banking analysts recently noted that while the headline inflation number shocked the public at 4.2%, that core metric, the baseline temperature, only rose by 2.9% over the past year. In fact, on a month-to-month basis, the broader consumer price acceleration actually stalled out at 0%, signalling that the rapid, unchecked momentum of price hikes might be taking a temporary breather. But Federal Reserve Chairman Kevin Warsh isn't playing a game of hypothetical mathematics. During his highly anticipated inaugural press conference, he made his philosophy aggressively clear. Addressing the media, he stated, quote, "You've heard me say before I tend to focus on the left of the decimal point. The 2 is the left of the decimal point. 0 is to the right." He doubled down on this pragmatic approach, adding, quote, "What we're interested in is what's happening right now. What we're less interested in is echoes of history." This wasn't just a change in tone, it was a declaration of war on market speculation. Warsh was signalling that the Federal Reserve would no longer base its decisions on optimistic forecasts or trimmed averages. They were looking at the cold, hard reality of the present moment. And the present moment demanded action. Financial outlets immediately broadcasted the central bank's official move. Warsh and his committee definitively chose to hold their benchmark lending rate entirely unchanged, locking it into a tight window of 3.5 to 3.75%. They also froze the interest paid on reserve balances, cementing a highly cautious, restrictive environment. This decision sent a ripple effect through the corporate world. we have seen massive technology conglomerates quietly embarking on a historic borrowing spree over the first 5 months of 2026. Anticipating that debt would become much more expensive, these institutional giants aggressively secured capital while they still could. At the same time, banking regulations surrounding liquidity and capital requirements are quietly undergoing a massive structural overhaul. While we won't dive into the exhaustive minutiae of these regulatory blind spots, the overarching reality is clear. Major financial institutions are unchaining their balance sheets. They are preparing for a landscape where lending is highly lucrative and where capital flows directly to the titans of industry, leaving the everyday consumer fighting for scraps. To truly comprehend the gravity of this shift, we have to look at the money itself. The sheer volume of liquid cash circulating through the American system, known as M2, is currently hovering around $20.8 trillion. It has hit a hard, unbreakable plateau, effectively ending the unprecedented era of pandemic-level money printing. Simultaneously, the central bank is actively pulling cash out of the system. The Federal Reserve's total balance sheet has been systematically drained down to roughly $7.2 trillion. This is a deliberate, calculated extraction of liquidity. And yet, despite this tightening, the economy refuses to break. The latest data shows real gross domestic product continuing to expand at a rate of 1.3% quarter over quarter. It is visibly slowing down, yes, but it is not collapsing. During his address, Chairman Warsh laid out his own internal projections for this ongoing resilience. According to the official transcripts, he expects real economic growth to hit 2.2% this year, while overall inflation remains stubbornly elevated at 3.6%. This resilient economic backdrop creates a profound problem for anyone waiting for cheaper loans. And this is exactly where the internal mechanics of the Federal Reserve come into play. Whenever the central bank meets, they release a highly scrutinized document known as the Summary of Economic Projections, or simply the dot plot. Imagine you are on a massive commercial flight, and instead of just one captain, there are 19 different pilots in the cockpit. Every few months, each pilot places a single sticker on a map to show exactly where they think the plane should land by the end of the year. The dot plot is exactly that, a chart where every Federal Reserve official places a literal dot to reveal exactly where they forecast interest rates are heading. And in June of 2026, those dots completely shattered Wall Street's expectations. Market intelligence firms reported a massive, hawkish shift in these internal projections. The median forecast for the federal funds rate was violently pushed up to 3.8% by the end of the year. This meant the central bank wasn't just pausing, they were actively preparing to hike rates higher. Exactly 9 Federal Reserve policymakers updated their dots to signal at least one more rate increase before the year closes. The dream of a rate cut cycle was officially dead. This marks a radical departure from recent history. We all remember when the effective federal funds rate peaked at an agonizing 5.33% during the height of the inflation war. While we are lower than that historic peak today, Warsh's new trajectory guarantees that borrowing costs will remain punishingly restrictive for the foreseeable future. What makes this even more challenging for everyday consumers is the strength of the labour market. The national unemployment rate is currently resting at a historically tight 4.0%. People have jobs. People are spending. In fact, recent monthly data revealed the addition of 172,000 new payrolls. This relentless employer demand is the exact reason inflation refuses to die, and it forces the Federal Reserve to keep their foot heavily on the economic brakes. But the most dangerous aspect of Kevin Warsh's new regime isn't just the interest rate itself. It is how he is communicating it to the public. For years, Wall Street relied on a psychological safety net known as forward guidance. Think of forward guidance like a massive cargo ship navigating a narrow harbour in the fog. To avoid panic, the captain blares a loud horn long before making a turn, giving all the smaller boats plenty of time to get out of the way. For years, the Fed used careful, predictable language to broadcast their future interest rate moves months in advance, holding Wall Street's hand so the markets would never be caught by surprise. Kevin Warsh just permanently disabled the horn. In a staggering display of brevity, Warsh slashed the central bank's official policy statement down to a mere 132 words. He completely eliminated any and all hints regarding the Fed's future moves, There is no more hand-holding. The market must now survive on its own, reacting blindly to real-time economic data. This abrupt transition into the unknown brings us to the core of our macroeconomic reality, the 2026 capital vacuum. By keeping interest rates high and remaining fiercely unapologetic about it, the United States is engineering a structural environment that acts like a massive financial black hole, pulling global investment directly into American borders. To understand the sheer gravity of this vacuum, you have to look at the immense scale of the global players involved. We are witnessing a monumental concentration of global wealth. The United States continues to dominate the world stage, boasting a staggering gross domestic product of $25.4 trillion. Across the Pacific, China remains a formidable industrial powerhouse, maintaining an output of $17.9 trillion. Meanwhile, over in Europe, Germany is fighting to maintain its industrial edge, sitting much further back with a GDP of just over $4 trillion. When American interest rates yield high, safe returns, international capital floods out of struggling economies and pours straight into the US dollar. Financial markets are already pricing this in. Trading desks indicate an 83% probability of further tightening by December. Combined with recent geopolitical tensions, including threats from the US presidency regarding the Iranian ceasefire, investors are flocking to safety, pushing the dollar to an absolute 2-month peak and draining liquidity from foreign currencies like the Japanese yen. This capital flight has devastating consequences for emerging markets. Trading syndicates are already warning that the hawkish turn in Washington is actively suppressing foreign assets, with benchmark yields on Indian sovereign bonds dropping to the 6.8% range as global investors aggressively reallocate their portfolios back to American shores. But this engineered American boom comes at a steep, long-term price. The foundation supporting this massive capital influx is built on historic levels of leverage. The cost of this global expansion is written in sovereign debt. In Asia, Japan is navigating a deeply leveraged economy, operating with a staggering debt-to-GDP ratio of 255%. Across the Atlantic, the United Kingdom is walking a tightrope, holding a ratio of 104%. And right in the middle sits the United States, carrying a colossal national debt load at 123% of its total economic output, fundamentally altering how capital flows through the modern banking system. For the everyday viewer, this macroeconomic chess game translates into a brutal, two-tiered reality. If you hold premium assets like elite real estate, blue-chip equities, or corporate debt, the capital vacuum will likely artificially inflate your net worth as global money desperately seeks a safe haven. But the immediate reaction from the broader equity markets paints a picture of profound institutional anxiety. The moment the Federal Reserve's hawkish projections were released to the public, equities took a decisive hit. The S&P 500 erased its early morning gains, dropping 0.5%. The Dow Jones lost over 70 points in a matter of minutes, and the tech-heavy Nasdaq slid downward as algorithms and human traders violently reassessed the cost of doing business in a permanently expensive environment. If you are relying on cheap credit to buy a home, finance a vehicle, or expand a small business, you are standing on incredibly fragile ground. The era of free money is definitively over. The Federal Reserve has made its choice. They will protect the integrity of the currency and force inflation down to their mandate, even if it means fracturing the working class in the process. As we look toward the final quarter of 2026, the global financial architecture is undergoing a profound, irreversible stress test. Federal Reserve Chairman Kevin Warsh has drawn a hard line in the sand. He has replaced the comforting certainty of forward guidance with cold, mathematical data dependency. For those navigating this landscape, survival requires looking past the daily headlines and watching the deeper institutional currents. Moving forward, there are two critical macroeconomic indicators you must monitor to track the true impact of this capital vacuum. First, watch the European sovereign bond yields. As the Federal Reserve maintains its aggressive posture, European central banks will be forced into an impossible corner. If they lower their own rates to save their domestic industries, their currencies will collapse against the dollar. If you see European yields beginning to wildly diverge from American treasuries, it is a clear signal that the capital drain is accelerating. Second, Keep a close eye on private credit defaults within the United States. Big tech and institutional giants secured their funding early, but mid-level corporations are swimming in debt that is rapidly approaching maturity. If interest rates remain locked at these restrictive levels, the cost to refinance that debt will be fatal for over-leveraged companies. A sudden spike in private market defaults will be the very first domino to fall before the broader economy actually breaks. This isn't about fear, it is about understanding the mechanics of a changing world. The rules of the game have been entirely rewritten, and the capital vacuum has officially begun. Stay objective, stay calculated, and as always, watch the data.